$500 billion in paper wealth has simply disappeared. And the truly unsettling part is that almost nobody watching it vanish can identify the cause. They can describe the pain. They cannot explain what broke. There is a particular kind of American innocence that assumes prosperity is a permanent condition, interrupted occasionally by weather. It is the same innocence that assumed the Roman denarius would always buy bread, that assumed the Reichsmark would always buy bread, that assumes every single time that this time the rules of money are different. They are never different. They are only forgotten until the reckoning arrives, and the reckoning has arrived simultaneously this season for three groups of believers who otherwise share almost nothing in common except the conviction that paper promises eventually fail. Silver has fallen more than half from its peak. Gold has surrendered more than a quarter of its value. Bitcoin sits beneath a long-term threshold it has not seen breached in years. These are not three separate stories. They are one story told in three currencies of belief. And the failure to recognize that as costing people money, they cannot easily replace in confidence they may never fully recover. Consider silver alone because silver's arithmetic is the most transparent of the three, and transparency is a kind of mercy in a moment like this. The metal is trading near $59.16 an ounce. In the early months of this year, it touched nearly 120. That was the peak. The moment when every patient holder who had spent a decade arguing for undervalued hard assets felt for the first time in a long while validated by the market rather than merely by their own conviction. The validation did not last the season. From 120 to 59 is not a correction in the casual sense of the word. It is closer to what a 19th century banker would have called a panic conducted at the leisurely pace of a modern market, rather than the frantic one of a 19th century trading floor. Pain of that magnitude does something predictable to the mind. It replaces analysis with narrative. And narrative in markets is almost always wrong, because markets do not care what story you have told yourself about why you own something. They only care what other people are willing to pay for it at this particular hour. So set the pain aside for a moment, not because it is not real, but because it is not useful, and look instead at what actually happened on the chart over the weekend, which is where the more interesting argument lives. Silver opened near 59.20, rallied briefly toward 59.55, and then absorbed a wave of selling severe enough to push it down to 58.60. That is the low. And at that low, something happened that deserves more attention than it has received. Buyers arrived, not tentatively, but in successive waves and lifted the price back above 59, where it has since settled near 59.16, a level defended that decisively earns a name in the trader vocabulary. It is called support, and the zone in question sits roughly between 58.46 and 58.65. Call it the floor, understanding always that floors in markets are reputations, not guarantees, sustained only for as long as enough people agree to believe in them. Should that floor give way with conviction, the next zone where buyers have historically reappeared sits near 56.50, and beneath that, in the realm of the genuinely unpleasant, lies a path toward 50. The ceiling tells a mirror image story. Resistance between 59.40 and 59.60 has turned back every serious rally of recent weeks. And the round, psychologically loaded number of 60 sits just above it, behaving the way round numbers always behave in markets, which is to say, irrationally heavy. Until silver can close decisively above 59.60 and then use that level as a foundation rather than a ceiling. The path towards 60 and beyond remains in the most literal sense blocked. So here's the geometry of the moment. A floor near 58.46 to 58.65, a ceiling near 59.40 to 59.60, and a price trapped in the narrow corridor between them, like pressure building inside a sealed container. Eventually, something gives. The interesting question, the one worth your attention, is which wall fails first. The indicators offer no tidy answer, and there is a kind of intellectual honesty in admitting that rather than manufacturing false certainty for the sake of a clean narrative, The Chaikin money flow reading, which measures the quiet movement of capital into or out of an asset, sits in positive territory near 0.19. That is a constructive signal. It suggests patient money has been accumulating even through the worst of the decline. The financial equivalent of someone buying property in a neighborhood, everyone else has fled. But the MACD, the most widely watched momentum gauge in technical analysis, tells a more cautious story. Its line hovers just above zero, pressed close against its signal line rather than separating cleanly from it. And the histogram, the visual measure of that separation, is barely positive and appears to be flattening. Translated out of jargon, the energy behind the bounce is not building. It may be stalling. Two instruments, two different testimonies. Capital flowing in is encouraging. Momentum failing to confirm is not. A market telling two stories at once is not a market in crisis. It is a market that has not yet made up its mind, and the most expensive mistake available to anyone watching it is to pretend that it has. There is a further layer here drawn from Fibonacci retracement analysis that rewards close attention. The recent low near 58.46 lands, almost precisely at the 78.6% retracement of silver's prior major advance. One of the deepest levels in the entire Fibonacci framework, and effectively the last line separating an ordinary correction from a genuine trend reversal. That the bounce arrived almost exactly at that mathematical boundary is not coincidence. It is the consequence of enough traders and institutions watching the same number that the number becomes self-fulfilling, at least for a while. Should the bounce hold and extend, recovery targets near 63, 66, and 69 come into view. Not a return to 120, but a meaningful stabilization. Should it fail, the same framework opens a path toward 51, another 14 or 15% below where we sit today. If you are holding silver through this, you are asking yourself somewhere beneath the technicals a far older and more human question. Did I make a mistake? That question deserves an honest answer rather than a comforting one. Volatility and permanent loss are not the same phenomenon. However identical they feel at 3 in the morning, assets have lost half their value and gone on years later to eclipse their old highs. It has happened to gold, to silver, to individual companies repeatedly across more than a century of market history. But there is a version of holding rooted in understanding and a version rooted in hope. And only the holder in the privacy of his own ledger knows which one he is practicing. What is happening to silver cannot be understood in isolation from what is happening to gold and to Bitcoin because all three are casualties of the same unwinding trade. And that trade has a name worth knowing, the debasement trade. Its underlying logic is neither exotic nor new. It is in fact one of the oldest observations in economic history, older than economics itself as a formal discipline. When a government spends well beyond its means, when the institution charged with guarding the currency instead expands it to finance that spending, when the resulting debt reaches levels without precedent, the predictable consequence, given enough time, is that the currency buys less than it once did. The Roman emperors learned this by clipping the silver content of the denarius until the coin was eventually silver in name only. Weimar Germany learned it in a single catastrophic decade. The lesson recurs because the temptation that produces it recurs, and investors who believe the modern version of that story is unfolding again have for years now sought refuge in assets a printing press cannot manufacture more of. Gold has played that role for several thousand years, valued precisely because it is scarce, durable, recognized everywhere, and entirely indifferent to the decisions of any central bank. Silver carries the same monetary pedigree, but adds something gold lacks, a genuine and expanding industrial appetite. Solar cells require it. Electric vehicles require it. Advanced semiconductors and medical instruments require it. Silver is therefore not merely old money. It is also somewhat awkwardly new technology, and that dual identity gives it a demand profile gold simply does not possess. Bitcoin arrived more recently as the digital claimant to this same throne, capped algorithmically at 21 million coins, marketed not without a certain self-conscious grandeur, as gold reimagined for an internet age. For a stretch of 2024 and into 2025, the story held. Capital poured into all three at once. Gold climbed from under $2,000 toward nearly $5,600. Silver surged from under 30 toward almost 120. Bitcoin rose from roughly 40,000 past 100,000. Three assets, one belief, one extraordinary run. That run ended for a reason. Most participants had stopped pricing into their expectations. The arrival of a genuinely hawkish Federal Reserve. The new chairman made the institution's priorities unmistakable from his first public remarks. Inflation, not growth, is the concern that governs policy, and the willingness to keep interest rates elevated even as the broader economy cools is real rather than rhetorical. Markets that had spent more than a year positioning for rate cuts were forced to reprice rapidly and without much grace. The expectation now embedded in financial markets is not for easing. It is for further tightening, with the Fed's benchmark rate potentially approaching 4%, and beyond as 2027 comes into view. That shift does something precise and unforgiving to assets that produce no income. When the real yield available on a safe government bond, the return after inflation rises meaningfully. Every asset that pays nothing while you hold it faces what economists call an opportunity cost. And the word cost is doing real work in that phrase. If a riskless treasury bond offers 4% or more, the implicit price of holding gold, silver, or Bitcoin instead rises with it because you are foregoing a certainty in favor of a conviction. As that foregone return grows larger, fewer investors are willing to pay it, and the appeal of the non-yielding asset shrinks accordingly. This is not sentiment. It is arithmetic indifferent to anyone's politics or preferred narrative. There is a second force compounding the first, and it lives in the dollar itself. Gold, silver, and Bitcoin are all priced globally in American currency, and a strengthening dollar, which is precisely what has occurred in recent weeks, makes every one of them more expensive to a buyer transacting in euros, yen, rupees, or reais. That buyer must first convert local currency into dollars before acquiring the asset. And when that conversion grows costlier, international demand softens, compounding whatever pressure a hawkish domestic policy has already created. A hawkish Fed, rising real yields, and a strengthening dollar. Three forces all pointed the same direction, all working against the very trade that lifted these three assets to their highs. That is the actual explanation for silver's collapse, for gold's retreat, for Bitcoin trading beneath a moving average it has respected for years. It has very little to do with any single headline, and everything to do with the slow, structural unwinding of a belief that had for a time been priced as a certainty. Before we go further, I want to say something to you directly, because this channel only works if the people who find it valuable stay close enough to keep finding it. If what you have heard so far has clarified something that felt confusing an hour ago, if you came here anxious about a number on a screen and are leaving with an actual framework instead, that is not a small thing. And it did not happen by accident. It happened because this channel exists specifically to do the part of the work that headlines refuse to do. Connect the dots between a price candle and the policy decision that produced it. There are a great many places online that will hand you a prediction and ask for your trust. This is not that. This is an attempt to hand you the tools so that you never have to trust a stranger's prediction again, including mine. If that distinction means something to you, the single most useful thing you can do, the thing that costs you nothing and genuinely sustains this kind of work, is to subscribe right now before you forget, before the next video in your feed pulls your attention somewhere else, and this entire framework quietly slips out of reach. Do it now while it is in front of you. Future you sitting in front of the next 50% drawdown, wondering what it means, will be grateful that present you did. Bitcoin's behavior across this cycle deserves its own honest accounting, because the story the asset's most devoted holders told themselves, and the story the price action actually tells, are not the same story. For much of 2025, while gold and silver were setting records on the strength of the debasement narrative, Bitcoin largely sat still near 100,000, and its community had a ready explanation. Maturity, decoupling, the arrival of Bitcoin as institutional money with its own independent logic. It was a flattering explanation, and like most flattering explanations, it did not survive contact with a real correction. When the unwind began, Bitcoin did not maintain its independence. It moved with the metals, and at points it moved faster and further to the downside than either of them. The asset that was supposedly graduating into a stable store of value behaved under pressure exactly like the highly correlated member of the hard money basket it had claimed to be leaving behind. There is, in fairness, a counterpoint worth stating plainly rather than burying, because intellectual honesty requires it. Measured from the lows reached across all three assets earlier this year, Bitcoin has actually outperformed both metals on a relative basis, gaining ground against gold and gaining considerably more against silver. The asset is still falling, but it is falling less than its older counterparts in this particular phase. And whether that reflects a genuine structural advantage or simply a different rhythm within the same broader correction is a question the coming weeks, not this video, will answer. Certainty offered before the evidence exists is not analysis. It is salesmanship wearing analysis as a costume. And you deserve better than that from anyone claiming to explain markets to you. What all of this tells us taken together is something larger than any single price level. When a macro trade built on a shared belief unwinds, it tends to unwind as one organism rather than three separate ones. The same logic that grouped silver, gold, and Bitcoin together on the way up is grouping them together on the way down. And that condition persists for as long as the Federal Reserve holds its current posture. For as long as real yields stay elevated, and for as long as the dollar retains its strength. None of that changes because of a single green candle on a single afternoon, however good that candle might feel to watch. So here is what actually merits your attention going forward. Stripped of noise, watch 58.46 in silver. It has held so far, but markets are patient institutions, and they test the same level more than once before they respect it permanently. A decisive close beneath that line, sustained rather than a brief intraday dip in recovery, would meaningfully alter the picture, opening a path first toward 56.50 and beyond that toward the 50 region. Watch 59.60 on the other side. That is the ceiling that must break for the broader story to improve. And a clean move above it followed by silver treating that level as a floor, rather than reversing from it, would signal that buyers have reclaimed structural control with recovery targets near 63, 66, and 69 coming into genuine view. Watch the MACD for confirmation rather than mere hope. Across of the MACD line, above its signal line with the histogram turning positive, suggests the bounce has real energy behind it. Deterioration back below the signal line suggests the bounce was a relief rally wearing a recovery's clothing. Watch the dollar because the dollar index remains among the most reliable leading indicators available for the entire hard asset complex. Meaningful weakness there would ease the opportunity cost pressure on all three assets and widen the pool of international buyers able to afford them. And watch the language coming out of the Federal Reserve, not merely its decisions, because markets trade on expectations of what a central bank will do far more than on what it has already done. And a single shift in tone, an acknowledgement that the tightening path may be nearing its end, could move hard assets meaningfully and quickly. Beneath all of this near-term technical machinery, silver's industrial story continues regardless of what the Federal Reserve decides in any given quarter. The global transition away from fossil fuels demands enormous quantities of the metal. Every solar panel manufactured anywhere in the world consumes a measurable amount of it. And the continued build-out of renewable infrastructure creates a structural floor under industrial demand that does not evaporate simply because monetary policy has turned hawkish. That industrial case operates on an entirely different timeline than the monetary case currently under pressure, which is precisely why so many analysts who sound cautious about silver this quarter remain genuinely constructive about it across a multi-year horizon. Separating those two cases, the near-term monetary story that is struggling and the longer-term industrial story that remains intact, is the difference between panic and perspective. Markets, despite every appearance of randomness on a bad afternoon, are not actually chaos. They are structure. And structure is simply human behavior, fear, greed, and the occasional flash of rational calculation expressed as price. Understand the structure, Know the levels, understand the macro forces working beneath the surface, and you stop being a passenger carried along by every headline. You become instead a participant capable of distinguishing genuine signal from manufactured noise, which is the only durable edge any of us actually has. Silver sits near 59.16. It bounced from a Fibonacci level of real historical significance. Momentum is divided. The macro backdrop is genuinely difficult. The Federal Reserve is hawkish. The dollar is strong. And the debasement trade that carried silver to 120 is at present in active reversal. And yet support is holding. Capital is quietly accumulating. And the levels that will define the next major move are already known to anyone willing to look at them clearly. That is the entire framework offered without embellishment. What the market chooses to do with it is, as always, the market's decision rather than mine or yours. But I would rather you enter that decision informed than frightened, and informed than hopeful, because hope as a strategy has never once moved a price. Before you go, I want something from you that has nothing to do with a price target. Because price targets, frankly, are the least interesting question on the table tonight. In a world where government debt keeps climbing without any serious political appetite to slow it, where the purchasing power of paper currency keeps eroding across decades rather than years, and where central bank policy keeps reshaping the investing landscape every single cycle, what do you actually believe in? Your own judgment is the most reliable long-term store of value. Gold, silver, Bitcoin, real estate. Something else entirely that none of us have mentioned tonight. Do not just think the answer. Write it in the comments where it can sit alongside everyone else's, and tell us collectively what an entire community of skeptical, careful people actually believes when the cameras and the charts are stripped away. This is the conversation that matters more than any single candle on any single chart. And I genuinely want to know where you stand. And remember, this is for education and discussion only, not personal financial advice. Subscribe to Smart Retirement Life for more analysis.